All right, welcome to tonight's webinar. And what we're going to go over tonight, or tonight's topic, is call spreads versus. And I name I have it on the beginning slide. I have it call spreads versus outright calls, but it's basically option spreads. We're going to go over both debit spreads and credit spreads. Uh, Does everybody know what the difference when I say credit spread or debit spread? I use those a lot, and I'm always thinking that people know what I'm talking about because I think for the most part in the room we have more advanced traders and of traders that have been trading for a while. But so we'll go over those concepts just in case because I use them all the time, and I think that everybody knows what I'm talking about. But it's okay. Like it takes a while to kind of get familiar with the terms and learn them. But so this should actually say, I don't know why I started with calls. I guess because I've been trading more of this stuff. But it's really, using spreads versus just outright options. So I'll make you read the little webinar or the disclosure. And I know my computer's slow right now. Risk disclaimer, right? So everything that we're doing in tonight's webinar, as always, is for information purposes only, no advice or recommendations. But I will say you could do this or you could do that. I just mean hypothetically, right? So again, everything is for information purposes only. You know me, you know my background. I probably need a new picture at this point, but it is what it is. Okay, so let's go into debit spread. So I want to go into like the pros and cons. You will see me use call spreads and debit. You'll see me use call spreads, which I'm usually buying, right? Because I'm doing more trades while the market is moving up. I'm doing more trades that are calls that I'm looking to express a bullish opinion versus a bearish position. But there's a lot of reasons why I do spreads versus outright options. New picture. Yeah, yeah, something like that. Yeah, maybe I'll draw on a beard or something. Um, but yeah, so I'll use these. You'll see me use these frequently, right? Where I'm actually using spreads versus just buying outright calls. So let's go. So I think also they really help me visualize what I'm looking to do with a position when I think it's going to happen. So the best thing I could do is kind of run you through a couple examples where I use them, and we could talk about some new trades too. But I'll bring up the master. I'll bring up a couple examples, and the one that comes to mind is Mastercard. That works pretty well. So so a lot of times what I'm looking for is basically just a defined move, right? So, oh, I have another pro in here. So I'll add this too. I knew I was going to think of more just as I go through this, but helps for high priced stocks, which I will get into. But Mastercard was a good example, right? This was not that expensive of an option. Mastercard, the implied volatility is not that bad. But what I was looking for in Mastercard, it is a high price stock. And I think when I put this on, it took a little while, but I did the 200 210 call spread. So there's advantage. I think I did better, or is that what I did? Or maybe I did a $5 wide spread. I think it was actually just $5 wide, $5 wide. What are you guys doing with this? These pictures. So let's see. It was just a $5 wide call spread, right? So I got into this for $1.40. So the 205, all the way back here, I was looking at the 205 210, right? So why was I looking at that particular spread? Because I thought that the price, Mastercard has this, as does Visa, has this pattern of kind of coming into the 50-day moving average as support and then rallies. So I was holding this for about a couple weeks, and it worked really well. I defined exactly where I wanted it to get to, 205, 210, and I got a little bit lucky because it expired this week. and I got the move that I was looking for. Now it took a while, so I think I would have been better off doing the call spread versus buying the calls because I just went out basically 3 weeks. I think this trade only lasted for 3 weeks. But if I would have bought the end of the month August options, the August 31st calls, and nothing happened for 3 weeks, I would have lost money. So by buying a call spread, you're defining where you think it could go, and you're also reducing your cost by buying the nearer term strike. So first of all, it's you know I should have in here what it is, but for a call spread, you are buying closer to the money strike and selling a further out strike. And I can't type it all. Right? So you're basically trying to figure out where the stock could go in a certain amount of time. So what's called defining the move. It's cheaper than buying outright calls. This bullet point, you're also minimizing a high volatile name, right? That really comes into play when you're talking about an event like earnings. So we were looking at so first of all, what's the price of before I move on to the next example? But if we look at the price of the MasterCard options, that expire this week. It's you don't have to worry about the implied volatility. It's not that bad. It's a 20. And the options weren't that cheap. In this particular situation, I was just looking to define where I thought the stock could go to and the cheapest way to do it. Yeah, lowers. It helps in that sense. But really, so when you start to look at the other reasons why you would want to do it, if you look at Tiffany's that reports earnings tomorrow, look at the implied volatility. Right, it's 100. Right, so buying. We talked a little bit. I didn't really get to go into detail about this because I was covering some other subjects during the midday session. But if you're looking at the Tiffany 130 options at the money options, look at the price of these things. Right, they're implying 100% move. So what that means is tomorrow, if Tiffany's, when they report earnings, and let's say they don't do anything, let's say they stay at 130, or even go up to 131, right, which would be a winning position if you bought the stock. But let's say it goes in the right direction and just goes up to 131, and you buy the 130 options, and what's the mid market? Let's just use the last of 524. You're basically going to lose $5.24 minus the intrinsic value of the option, which would be $1. So you're going to lose pretty decently if the stock doesn't move, right? That's what implied volatility means, is that it's really pricing in a big move. If you don't get a big move, you lose, and you lose pretty decently if you just bought the calls outright. So what can help you during earnings season is you could actually do a call spread, and you can help minimize that implied volatility. So you could do something like if you wanted to do a $5 wide call spread, and let's say you wanted to stick with 130, you could do the 130, 135, and you're risking. I could probably do this. What was the last? The last was $3 for the 135. So you're spending what, 224, and you can still make the $5. So let's say that the stock goes to 135 for expiration, right? You're spending 224 for that call spread because you're buying the 130, selling the 135. You're spending 224 for that, and you're going to make the width of the spread, which is $5 minus the premium that you're paying. That's $276. So you will make $276. Let's say that the stock goes up to 135 and you just bought the 130 calls. Let's say that you paid 524 and the stock goes to 135 tomorrow. What's your profit or what's your loss? Anybody want to answer that question? You spent 524 for the option, and by expiration the stock closes at 135. Right? So if you bought the 130 option, you're paying 524 and the stock closes at 135, so that's an intrinsic value of $5, and you paid 524 for that option, so you're actually going to lose 24 cents, right? So that's the difference by using, especially for a name that has a huge implied volatility going into earnings. There's that difference of how you structure the trade can mean whether or not you had a profitable trade. Again, the 130, 135 call spread, you would earn money on that because your net outlay is not that expensive. But if you just bought the calls for 525 and the stock goes to 135, you're actually going to lose money. You actually need the stock to go higher than 135. Right? Any questions about that so far? But that's a big, that's a big deal, and that's why for earnings, I like to participate in earnings. But if I decide to go outright, I would actually rather go further out than the weeklies, because if you look to see what happens along this volatility curve with the expiration, right? So these are around 99. If you go out to September, it's still an expensive option. But if you bought the 130s, at least the implied volatility is only 44. Right? So I would almost rather buy the 130 options for $6 than buy these, just in case it takes a while for the stock to get up there. And so again, the price of just going out by having a lot more time to expiration is not going to cost you that much more because of that big event that's coming up, which is earnings tomorrow. All right, so when I decide to play earnings, if I decide that if I don't want to use a call spread, oftentimes I'll go out and I won't do the weeklies because the implied volatility is just too much. Okay, and then the other reason, the last reason, and I did this very quickly, so if we think of other reasons, I will type them in, but it helps with high price stock options. For example, I like to play Amazon a lot. So Amazon is I can't believe this stock. 1927 is where this thing closed. A fine year. No, I'm just kidding. So 1927. And if you're looking to play options with this, it's difficult for me because when I purchased this, just one contract, as I bring up the option chain for Amazon. There we go. Again, my computer's super slow. But let's forget about the weeklies for a minute. Let's say I want to go out, again, very short-term trade, just going out to September, and let's say I want to buy a little bit out of the money options, let's say the 1935. I've got to spend $3,600 per contract, right? That's a lot of money per one contract. Sometimes my maximum trade could be $5,000, so I can't even buy two contracts. If I only wanted to spend $5,000 per swing trade using options. So you just can't do it doing for outright call. So a lot of the times what I'll do is, I'll buy, let's say the 1935 call and I'll sell the 1945 call, and that's more manageable. And let's see what we can find for that, what the net price would be. So it's a great way to participate in these names that no longer split or that just aren't going to split because for whatever reason they don't want to have stock splits. So you're kind of stuck if you just want to buy outright calls to committing a lot of capital. So let's say, what did this thing close? 1365 minus the 31. So let's say you wanted to do a 19. What did I say? 1935, 1945. So you're going to buy the 1935 strike for September for 36.50 and sell $10 outside of that. That's the 1945, and you're going to collect 31.85. So that's $4.65. And if Amazon continues to rally, goes through that strike, the most that you can make on that trade is $10, right? So you're instead of spending $3,600 or $3,650, you're only spending $465, a little bit less than $500. I'm going to get into the cons. Obviously, you're capping your upside, but if you're just looking for Amazon to continue to grind, then that might be a better trade for you. So, again, defining the move, which again is very important. Whenever you take a trade, before you take the trade, you should already have in mind where you think the stock can go. If you're not doing that and you're just saying, and I know this sometimes happens if you are following option activity and we see calls that just go up on the tape right away and you're like, oh, I want to take that trade. And sometimes with these trades that we see on the tape, you're forced to just get in very quickly because you're afraid that the stock is going to take off. But that may just be a day trade for you and you're not really thinking about a swing trade and where you think the stock could go in the amount of time. If you're setting up that way and you're doing your research, you should always be thinking about, we'll go back to that MasterCard trade. So when I entered into that trade, now again, it doesn't mean it's going to go there, but I did the analysis where I thought the price comes into the 50-day moving average a lot and bounces. So, I defined where I thought it could go and the time that I thought it could take to get there. So again, doesn't mean that that's going to work every time for you, but at least you're going through the motion of analyzing, the historic price action of the stock, thinking about whether that's reasonable, thinking about how much you're spending versus how much you can make. All things that could be done either regardless if you do spreads or if you do it with calls. But it really helps with spreads because when you pick that upper strike, that's as far as it could get to, just like I did with the Amazon example. Okay, so that's my 6 different pros about debit spreads. Any questions before we go on to the cons? Or anybody want me to go through another example? We could go through examples when I go through after I go through the cons. So there are some negatives. There's not just positives when you do spreads. There's some things that frustrate me. If the stock, so again, for MasterCard, right, that it's kind of a slow mover. It very rarely just goes ballistic, right? It's a grinder, right? It manages to continue to make new highs, but it's like a nice rolling chart pattern, right? It's not one of those that's going to blast through like AMD, for example, right? So if you would have picked so this would have been a poor choice. It's like the guy from Indiana Jones at the end of the last crusade, and they're picking the Holy Grail. You did not pick wisely, right? So if you would have picked call spreads in AMD and this thing shoots up to the moon, as it did from $19 to 25, let's say somewhere in here you were looking for a breakout and you bought the 2023 calls and the stock goes up to 26, right? You're going to be a little bit upset because you're limiting the upside as far as, if you put a $3 wide spread or a $5 wide spread, you are limiting your upside. That's the most that you can make, is basically the width of the spread minus the premium that you're collecting. Right? So that's the so it's going back to the pro. It's nice because you're spending less premium than you would for an outright call. Cheaper than buying outright calls. But you're capping your upside, limiting, capping, however you want to call it. Second of all, you need to get the timing right. And that could be frustrating. Like, that almost didn't work. If it would have taken longer for this MasterCard trade to work, I could be right about the direction, but if I'm wrong about the timing, and that's with any option that you take, right? So that's not so much just with spreads, but really defining the expiration can come into play for either, just with either option that you choose, whether it's an outright option or a spread. You need to get the timing right. This can also play into the third bullet, which I have here, which can be frustrating as well. This happened to me in Restoration Hardware, where the stock goes all the way through the upper strike, but I have too much time on my option. So this would have been tricky. I don't know if doing an outright call would have been better, because the option it's very, very similar to the example that I used for maybe Tiffany, because it's just that high price of a option, right? If you look at this thing, the implied volatility is like a 50, and I think this is earnings, but you can see it's over 100%. It's very expensive. So that could actually work against you if the stock blows out to the upside. So for Restoration Hardware, I think it was the 140, 150 call spread. Or no, I had a $5 wide one. So I had the 145, 150. And the stock was trading at 158. So $8 above my upper strike, but I could not get the full $5. Why? Because the implied volatility can actually work against you, because you still have a lot of the uncertainty of what could happen. And going back to when I took it off, which was Friday, you have the uncertainty of a whole week that the stock could actually get back below 150. And when you have a very high volatility name, such as Restoration Hardware, where this implied volatility is at 50%, so that means the stock could really move. Right? So sometimes if you don't time it perfectly, you won't get that $5, because you have to wait till all the way to expiration. Versus the outright contract will actually be worth more. All right, so there's a little bit of a difference there, between and how that can go, and that's why if you're trading spreads out a couple months, most of the spreads that I use are going out pretty short term, because if the stock goes through, like let's say Restoration Hardware, and I chose this, and I had September expiration, then I was able to get out of this, the $5 wide call spread. Again, maximum I could get, the price that I could get to is $5. I think I got $4.20 on this. But if I was in a September option, even though the price is way above that 145, 150 call spread, it would probably only be marking at around $3, right? So it could work to the detriment of if you go out way farther and the move happens right away. Another bullet could be is avoiding buying earnings. Yes, so that's kind of what I meant with Restoration Hardware. So I think this name reports. So I'll answer this question fully, but I know exactly what you're getting at. Base example from Friday that was going in your direction, spread went $60. Yeah, and was only making $10, 10% profit. So yeah, so for this one, right, it reports 9.4. So I want to be careful, because you see what happens to the options, right? They report on the 4th, which is just a week away, and you see what happens to the price of the options. It goes from the implied volatility goes from a 50 to 108. And yes, because you have that event in there. So now that I know that that's the reason why the implied volatility is so high, which I thought that was the case. But if I had that $5 wide spread, let's see, I could actually price that up right now. So it's trading at 153, 152. And let's say I had the September. Where's the price? So 1550. Yeah, so it's only marking at what, 225? 1550 minus 1226, right? Yeah, it's 324 actually. Sorry, 324. So yeah, so even though it's gone through the upper strike, it's marking at 324. So still, it's not going to realize that $5 wide, that $5 value, because you have a big event, and it won't do that. Same thing with a drug announcement too. If there's a big drug announcement and you have a spread and the stock is trading, let's say the stock is $100, the stock's trading at 110, 115, and you've got a big drug announcement coming up, there's no way that you're going to be able to realize that the value of the spread, because you have a big event that could cause the stock to trade well below the 100 by expiration. So absolutely. So I think there's a lot of reasons. It's another tool in your toolbox. Whether or not you want to use these, when I trade short-term options, I would rather define where I think the price can get to, and reduce my capital outlay. Because again, trading in the short term is a lot more difficult, because not only do you need the timing, not only do you need the direction to go right, but you need to time it correctly. So if you're going to play in the short term option arena, I think you could do a nice job by defining your risk by using options. You're defining your risk. You're spending less. Well, you're doing that with a normal option. You're defining your risk, but you're reducing what you can lose on an option, and you're defining where you think it can go in the short term. All right, so that's why I use them so much. And then some of the other reasons. I like to trade Amazon and I like to trade Google a lot. And I'm not going to spend $3,600 for, I'm just not going to do that. That's too much money to risk for one contract for a couple weeks away. You're kidding me. That doesn't seem reasonable. But spending $400 for a $10 watch, and I generally like to spend, I can give you a couple of my best practices, but when I do this for Amazon, which I like to trade Amazon a lot because I think Amazon is just a best in breed stock. And I think of whatever, regardless of the different market rotations that we hear about all the time, CNBC loves to talk about rotations. Amazon is just like, it's best of breed. When people were rotating out of tech or out of FANG stocks, basically three of the four FANG stocks got hit. Which one didn't get hit? Amazon. So if you go out and let's say you wanted to put one of these on, what I like to spend about 35% of what I can make. So for a $10 wide spread that I want to make, if I want to see the stock get through a $10 range, through that strike, I only want to spend about 350 to 360, 370, and that's it. Right? So, we could try to figure this out. And I know Amazon is not, to me, I like to do this whenever Amazon sells off. And I did this, I think back here, but unfortunately I did not get that big of a trade on. I was kind of legging into the trade, into weakness, and we went all the way down here, and I got bought up very quickly, and that's the that's the lowest. I guess I had an opportunity to add to it here, but I actually like caught the very low that day. So, if you think about, well, it could probably get to what, 1950 if this continues to kind of ebb and flow. But I would rather wait for the next time this maybe ducks back in. But let's say 1950 that we think this can get to. So I don't think this is the perfect time to do this. But let's just say for practice. So 33.95. We'll just take the last marks on these, even though we're dealing with a spread. Minus 29.85. So that's going to cost you about $4. That's a little bit too much. So I might even go up to the next strike. So that'll cost you $4.10. So what I do is a little bit of trial error. Okay, well that's going to cost me $4.10. Maybe I try the 1945, 1955 strike to try to bring the cost under $4. But that's kind of what I go through in selecting strikes. But again, I think it now on a 52-week high is probably not the best time to do it. Google, I think, is actually more attractive here, even though this one also broke out of this. I actually just closed the spread today in Google, but this might look a little bit better because I think it has more to go. Why wouldn't it get back to the earnings high? This one, and this is a good name, I think, to do that strategy because it just kind of, it ebbs and it flows, besides for earnings. So I think that's a good way to play this name to Amazon as well. So then we can move on to the next the next slide, which is going to be on credit spreads, which I also trade a lot of. Any questions so far before we move on to credit spreads, which I'm also going to cover? Because like I said, I thought we could go through this pretty quickly. Any specific delta that we could keep in mind? I think it's more about cost. So like I said, I like to spend about, I have a range. So that 35, you're basically thinking about it in terms of 35% is of what you could completely make. Yeah, I mean, unless you really think it's a big size move, right? So if you did that, let's pick a name that doesn't have that many strikes as Amazon. So I don't think it's so much about the delta for spreads, but we could talk a little bit about delta too, if you have questions about that in particular. But let's say you went out to September, and I need to just move the strikes, add the number of strikes. But let's say, so here's your delta, right? So you're really looking for a huge move. So what's the advantage of doing? So would you rather spend at this point, right? This becomes almost like lotto territory because you need a huge move. So you're spending 27 cents. So why I think this is no point in doing this as a spread. If you did the 225, 230, right, you're reducing your cost basis by 10 cents, but you still need a huge move. So the reason why you do the spread is because you're going for a more closer to the money. You're looking for a move just very, close to where the stock is trading. If you're going out and you're using a 10 or 15 delta, you're looking for a huge move. And the price of the options will be cheaper because of that huge move. right? It's less probable, right? There's probability that's associated with the move. So, looking at MasterCard in the next couple weeks getting up to 225 after it's already moved a decent amount is not very probable. May for Apple, let's see. So if we bring up May, are there is there May options? Oh, not May, but you're just saying May. Use Apple as an example. Well, I think it's going to be the same thing. So if we use September, sorry, I misunderstood. You said May, and I thought that was okay. Gotcha. Yep. So if we look at September options, it's still going to be the same concept, right? This is September monthlies. So if you look at the delta, which is where's the delta here? So you said 15 delta. So let's say this one. So that's the 227. So that means another $10. It could happen, but I don't see the advantage of spending 33 cents for a $2.50 wide strike. I think you might as well spend the 76. So I think really the question was, would you go out further and do a spread, buy a spread, a debit spread for something that's low delta, something 15 to 10 delta? And my thoughts are no. I think for this sense, you just go ahead and buy outright calls. Because if you manage to get this huge move, right, you're not spending that much of it's not that much of a difference between 76. You're spending 30 cents. I don't know. I don't see the reason. I would just buy the outright calls if you thought that there was going to be a crazy move in Apple. So I think it's better. I think it's more widely used for closer to the money strikes where the strikes are expensive. But you could do it that way. I mean, there's no reason why you can't do it that way. You could save yourself rather than purchasing. So I generally don't like to go that far out of the money. And the reason being is I hate when the stock moves in the right direction and you get it right, but either the stock doesn't go far enough. It almost seems like a whole wasted exercise. And so you would have to ask yourself, right? If you go back to the chart, which Apple has been on a tear. Like, what would make it go up that high? I mean, it could do it the way it's been going, but I would be very frustrated if the stock went from 217 to 225 and you bought the 227 option and it moved $8 and you got nothing for it. So I like to trade more highly probable outcomes than going that far out of the money. And again, it could work. People do it. It's just not one of my styles of doing. And I think that's a lot of times when you look at the reason why options expire worthless is because people are really looking for big outside moves in short amount of time. Okay, so moving on. So that's debit spread. Sorry, went a little bit off tangent. Sorry if this was asked. If you had outright calls, lock some profits already, but have an expiration, then what would you make Sorry, let me try to repeat this. Sorry if this was asked. If you had outright calls, lock some profit already, but have an expiration, when what would make you want to sell a higher call to protect gains and ride along for more? Have time. Oh, have time, but have time to expiration. Okay, I see. So let me repeat the question now that I understand it. If you had outright calls, locked some profits already, and still have time to expiration, what would you want to sell a higher call to protect gains and ride along? Okay, so let's talk about the trade that I did on Friday. And this is a good example. This is I didn't have this in the little cute PowerPoint presentation, but what did I do? I did the Octobers. Did I do? So I actually have a lot of time on this trade. Yeah, I did the October 105 data calls, Tableau software, on Friday. So I think this kind of gets around, Rob, your question, and it just helps me when I kind of bring a real life example. So I had the 105. So let's bring up the chart too, because of course when I'm doing this, I'm looking at a technical setup and where I think the stock could get to. So originally, when I bought the calls, I was thinking, I thought it was a pretty good technical setup, and I guess I could have bought the September calls rather than the October, but I'm kind of once September becomes front month, I tend to avoid buying calls in September. I just like to go a little bit further out because I'm very cognizant of the time decay. If you don't get the move, this I got lucky in, right? We got a big, I purchased right on the move into value, and the name ended up rallying all day long, right? So we'll go up to not this. So this was on Friday. In data, 105 calls, 465, right? And the stock rallied all day, so the call become more valuable. So I could have decided what I wanted to do, and I could have just sold the call for, let's say, 550 or $6 wherever it was trading, or so this just is my comfort level, right? So I could have decided to sell some of those, and maybe I did a little bit. And then I decided to sell the 415 calls. Why? Because if I go back to here and what I sold these for, so I waited until it rallied, and it did, and then I was able to. I sold the 115 for 115, right? So I turned that into 105 115 call spread. So why I decided to do that is because I thought that there would be more upside to go, but I think that's an expensive call to hold. I think holding a call, that's trading over $5. Let's see where this thing is now. So if I bring up the data options for October, right, they're marking at about I guess the last is 540. So to me, that's expensive, right? So that's why I turned it into a call spread. I just thought that that's a lot easier for me psychologically to hold, because I think data is another name that's also ebbs and flows. I think we kind of caught it right at the value area. But I'm looking for this thing to push to a new 52-week high, just above here, and I think it could happen. Given a week, couple weeks. But I don't want to just have it let sit on my books if I think it's going to take more than a couple days, right? So that's a good way to do it. So did I answer the question? When would you want to sell a higher call to protect gains? So when I think that the move is going to take a little bit more time, because we know if I just would have went into September or even October, you have big theta decay every day. So the longer it takes for the position to move, the more you're going to lose by just sitting on the position. So I think data could take a little bit of time. I think it's going to take some, it's at 106 right now. I think it could get to 115, but maybe it takes a couple weeks. So if it's, and again, this, I don't know if that's going to definitely happen. That's what I'm looking for the trade to do. But if it takes a couple weeks to get to 115 and I'm holding those 105 calls, every day I'm going to lose value in that call because of the theta decay. Right? So if I decide to get into September or October options, and I think the position is going to take time for it to get to where my price objective is, then just an outright September October call is probably not the way it's going to do. Not the optimal way to do it. Because in those months, and I don't have the chart up in front of me, but if you Google theta curve decay, that front month and next to front month options, you have the biggest theta decay. So you're going to continue to lose value if the stock doesn't move. So that's why I'd rather pick a call option, because you're decaying on both sides. So it kind of neutralizes that. Does that make sense, Rob? But that's also a way to kind of lock in and lock in some of your gain by selling a contract against your original position. And that's essentially what I did on Friday. It's a way, because if I would have started that day, go back to this 115 option. But it's a nice way to kind of leg into a spread. This 115 option was marked at 226 last. In the beginning of the day, so if I would have put this on the onset on Friday, where I purchased the 105 call and I spent, $4 or something, I probably would have only sold this option at the onset for maybe 85 cents. But because it appreciated throughout the day, now I'm selling it for something of bigger value, which I sold that for, what did I say I sold it for? 150. Right? So I made money by waiting for the stock to rally to sell that upper strike. And I said that, I think, originally when I put the position on. So it's called legging into. Oh, I think I set it out in the alert on the private feed. So that's a great way that you could do it too. You could wait for your option to, if it stalls out, right, like data did. You could also. I'm trying to think of another example, but let's say Amazon. No, let's say Amazon. Let's say I don't know. We'll go back to Apple. Let's say you bought Apple here, right, and it manages to move up, and you're still thinking that it could go higher, but you want to lock something in. Then you could sell an out of the money call versus your long call. In this way, you're essentially locking something in. All right, credit spreads. So that's everything. And again, there's as we kind of go along and as I put on trades, because again, I will use them before I go into credit spreads. I will really use them for short-term trades, because I would rather outlay less money, especially for the high price stocks, that it's going to cost me a lot of money to put on an Amazon or a Google, and I think over a couple of weeks it could continue to grind higher. It's just very easier for me to use a credit spread, or again, if the name has got a super high implied volatility, and I don't want to spend $10 to get into, like this. Somebody brought this stock up to me today, and then we'll go over credit. I promise we'll go over credit spreads. But I think it's just really good to kind of nail home the point. By the way, there's only a $25 stock, but this stock right here, what's the implied volatility on this thing? Let's say I wanted to go out to October and buy an October call. right? So an October call, the 25 is going to cost me $3.20. That's a lot of money. Or even the this is not the best looking thing because it's $5 wide spreads for a very low price stock. So if I thought this thing could get back to $30, it would be appreciative if there was $2.50 wide strikes, but there's not, because I would rather do the 27.5, 32.5, because it's a little bit too much money for this. So that's 310 minus 147. So that's not bad. You're spending about $1.63 to get $5. If you think this thing can get up there. So I would much rather spend $1.63 than spend $3.10 on this because of the implied volatility. It's just too high. It's too expensive. Because you need this to get to $28 to get your money back. Right? $28 before you could get your premium back. Let's say at expiration. Obviously it's going to trade with that implied volatility all the way up. If it moves very quickly and it goes up to $28 tomorrow, the value of the call will still be there. But let's say it takes its time coming back. Right? So it really depends on the frequency of the move. But let's say it takes a couple weeks. The longer you sit with that name, that outright call, and it doesn't move in your direction, you're going to get dinged. That's good. So what? Rob's question? Let me read Rob's second question. One more question on debit spread. EA, we saw them roll calls down a strike. Why wouldn't they also buy back the upper calls sold to a lower strike too? So they did the 135, 155 spread. I don't know what OG means. Rolled to the 135 to 130s, but the 155s buy back and sell 145. So why did they do that? Why didn't they? Why? I guess your question is why didn't they roll down the upper strike? Is that right? Because they only rolled one portion of the. Okay, good. Okay, I got what you're saying. Okay, so let's talk a little bit about EA. What a pain in the ass this name is. Sorry, my French. Okay, so they did this trade on Friday, right? Is that what they originally went into? We can bring it up and figure it out. But I think that if you look at the pricing, that may give us a hint. Some of this is just preference. It depends what they want to happen. So let's bring this up. I forgot to look at the applied vol. No, I think I looked at this already. So they dialed down their exposure from 135 to the 130s, and they left this, right? So you're saying, why didn't they sell these, or why didn't they buy back their short 155s and then sell the 150s? And to tell you the truth, I don't know the answer to that question. What did they originally buy? What did they originally sell the 150s for? And I'm not sure if I'm going to have that history because it's been a few weeks now. This was the 155 call. Yeah, I don't know if I'm going to have the history. Maybe it wasn't enough to do it. Because remember, the closer to the money is going to be more sensitive. Maybe this value didn't change enough. Like, let's say, for example, this 69,000. Let's say they sold this for 210, and now it's only marking at 198. It's not that big of a deal. Meanwhile, the closer to the monies may have changed drastically in value. or more drastic. So there just may not been a big enough of a. My guess is there wasn't a big enough of a change in the 155 strike. Maybe they sold it for 220, and now it's marking at 198. So maybe it just wasn't enough of a change. Maybe it didn't appreciate enough. I mean, I don't really know why they did this in the first place. Why they rolled it down. I guess they wanted a more sensitive delta, but I really don't know what their motivation was. Maybe they're looking for a smaller move now, but I'm guessing that there just wasn't enough. There's not enough difference. So who knows? Unless we actually interview them, we could guess like we're doing, but you just don't know. But that's my guess is that the 155s did not move enough in price for them to really make an adjustment on that further out strike. Okay, good. Okay, so and by all means, please, more questions the better because it kind of, we'll go through more real life examples, which that's the best way to learn is by going through the examples rather than me going through a PowerPoint presentation. So credit spreads. I want to talk just a little bit about this unless I see more questions. But this is different. This instead of, looking to, and by the way, I didn't really talk about put spreads, but it's the same concept. You could buy a put spread if you're thinking that the stock is going to go down, and all the same concepts apply there. Credit spreads, these are great to do. I'll even add this. Great to do after a name has declined and has strong support. So something like this. So something like a name, like Facebook, for example, right? Name falls big time after earnings, but it falls right into support. Same thing with Netflix, and I think I did that with Netflix. So I can give that example why I thought that was good. I thought that there was a good technical level here. So when Netflix had earnings, where we all kind of know the story with Netflix, it fell on earnings. They didn't meet their subscription numbers. The stock was up huge, up 100% going into the print. So it had gone from 420. It had fallen, and I said once this thing takes out this virgin point of control, which I'm not going to explain those right now, but I think it's a good place for a name to possibly come back. So after a big decline, you can basically sell premium, thinking that the stock has moved enough, and you can collect money as long as the stock doesn't go any lower. If you're doing this, if you're selling put spreads. All right, and I always do this. I never really sell puts unless you're. I very, very rarely do that. You have to be comfortable if you're selling puts outright to basically buying the stock right there. And the stock could keep falling, but you have to purchase at the strike. So if that's a long-term trade, I would rather cap my downside. It's basically the same concept. You don't need the stock to rally hard. You just need it to stop going down. So I think it's really, I do this in a couple different situations. That's the one situation where a stock has fallen and it's fallen into support. So I did this here. And then what happened was I had time left. So as it rallied, I started to buy back that short put spread. I do not look to achieve full profit, i.e., if I sell a $10 wide, whoops, spelling error, $10 wide put spread, at, let's say, 320. So I'm just making up prices. But let's say, or 350, 340, whatever, 350. If I sell a $10 put spread, $10 wide put spread, and I collect 350, I will buy back around, let's say, 75% profit. All right, so something like that, 350, 75% profit would be around 90 cents. Right? So why do I want to do that and not let it go? A question for call. Okay, let me go back to the call spread question, but let me just finish this example. I do not look to achieve full profits because the risk is not in your the risk return is not in your advantage, right? Let's say that I did this for September. I sold a Netflix put spread. I have to wait all the way till expiration because Netflix is a name that bounces around. So, when I did this, and again, I don't think I'm using the right expiration, but when I sold this here and it rallied, I was able to take the last piece off. I don't know, maybe around 90 cents, or maybe it was a little bit more than that. Maybe it was $1.20, because I had a feeling that this was going to stall out, and you could see it went lower. So if I did not buy that spread back, I could have risked losing the whole trade because stocks move, right? I mean, stocks, 1 week it does this, another week it went all the way down. So depending on the expiration, you could get caught. And I did that with Google was the one. I should actually use that one because I did that with that was a trade that I did for Google, and I think I took Google off today. Now I probably could have kept this. I probably didn't manage this one to the best of how I could have done it. Now I bought this back at 70 cents. I sold it at 355. I should have just used this example. So yeah, maybe I could have kept the very last piece on, but you can only make 70 cents, and it's going to take a while. It's not going to go. This actually expired today, so expired on Friday. So maybe I could have held out. But let's say that this was expiring next week. Tomorrow, let's say the stock stays the same. It's probably only going to go from 70 cents to maybe 60 cents. Right? It's going to take the full time to get all the way down to zero. And there's a lot of things that could happen that could screw that trade up. That Google could actually go down. Right? It's just not in my best interest to try to get that last. Maybe I could have got this thing down to 50 cents or 40 cents, but to try to get that last 40 cents, anything could happen sometimes. And I've seen trades, I've been in them where I try to earn the last 30 cents and something blows up. And this was a $10 wide put spread. And now instead of, trying to get that last measly little bit, you have a loss on your hands. Well, you're done with credit spreads. Question for Google credit spread. So let me read the whole question because I know not everybody can see this in the video. When you're done with, so I think maybe this is the question that this is the trade that I did that you have the question. Question for credit spread from the recent Google trade bull put spread, which is exactly what I did. 1210 versus 1200, average 360. If I could risk the same amount, I could do 1210, 1205, 180 credit. But two contracts, I will have chance to take target. Do you see any problem or anything that I should be worried about putting that trade on? You're saying back then, Sanjay, or you're saying now? Yes, back then. Yeah, so that's just a different way to approach. It's a different risk. Being that you're doing $5 wide spread versus a $10 wide. Can you do the same amount? I do 1205, 1210. Yeah, so you could take the target, if you sold that for a dollar, if you sold that $5 wide spread for $1.80 rather than the 10 for 360. Sure, you could take, you could use the same concept, and I would personally take a target around like a dollar. You buy it back for a dollar, one target at a dollar, and then you could do the 75% rule and multiply the 180 times 0.25, and your last target would be around 50 cents. Right? That would be a 75% value of the $1.80. Right? So you might have to wait a little bit more time to get that. But again, it's all what you're comfortable with risking. When you do a $2 wide, sorry, I'm getting tired. When you do a $10 wide spread, right, you have to be comfortable that if the trade goes the wrong way, that you could lose. What did I collect? 360 originally, or something like that. You have to be willing to lose, that you're comfortable with again, whenever you get into a trade, you always want to think about the risk first, not the return. Always want to think about the risk first. And that's the danger. If we go so I'm at the pros right now. If you go to the cons of the credit spread, you can lose more money if the stock goes against you. Right? Will lose, or can lose up to. Can lose up to the width of the spread minus premium collected. So it's dangerous. I mean, you never want to get to the situation where you could blow out your account. This has happened to me before where I tried to do that. I think I tried to do. So I'll give you a horror story, right? And I don't mind sharing the horror stories because this is how you learn. So let's bring up the SPY from a couple of years ago. So I got burnt on this pretty badly. And I didn't do that. I kind of learned to do this not on the January pullback that we had. But if you go to a 5-year chart, this thing, right? This big move, which doesn't actually look as bad as this was. This was the nice W. Where's my zoom? Why won't this let me zoom right now? Usually I could do that. Well, I can't find it. So in any event, let's see if I can stretch this cheat a little bit. No, it's not going to let me do it. But let's say you do this, right? You decide on this first bounce and you sell put spreads. And you do this in a bunch of different names. And we go lower. And the market really. So the danger is that you essentially do this strategy like we did, like I showed in Netflix, and the whole market bottoms out. And it goes, 5% lower. You're going to lose. You don't want to put yourself in the position where you blow out your account. So you have to be aware, if you put on 2 or 3 contracts, you have basically about $2,500 of risk that you could lose $2,500. And meanwhile, you could only collect about $700. So you really want to do this versus in a name that's pretty consistent. You don't want to do it in a ton of positions at the same time, because if the market happens to swoon, and let's say that you did so right now for September, like we know September is a historically more volatile month. I would not want to sell put spreads that expire in September, because God forbid we get a 5% correction. You could really get hurt that way. So you want to stagger these things out a little bit too. You don't want to be doing a ton of put selling all around the same expiration, right? You're asking for trouble. Because nobody has a crystal ball. We do get market corrections from time to time. Nobody can predict them. Let's face it, nobody can predict a correction time after time. It's impossible. People try to do it all the time on Twitter. But if you've got 3 or 4 different trades and they all expire for September and you're selling premium, you could get clobbered if the market decides to sell off, let's say, that week before expiration. Right? So you would have to do some trade adjusting there. Right? Does that make sense? But I think from like a one-off, it's a nice little strategy, and something like Amazon and Google, which have been pretty consistent, you could kind of replicate a stock strategy. Not perfectly. Replicating a stock strategy is going long calls and short puts. That's the same risk profile as owning the stock. You have a limited upside, and you have downside all the way down to zero. And you're doing this with leverage, right? If you do what's called buying, you call it a double vertical spread. You could buy a call spread, you could sell a put spread, and then if the stock moves up, you've got a really nice return. And I do that a lot with Google and with Amazon. So you'll see me do that, or I'll say optional. One that didn't work last week was BABA, or 2 weeks ago, right? So there's times where those don't work, and you really have to, if you're going to manage that. And I think Sanjay, you may have had the question on that trade. Once the trade, so right now I've got a trade right now that I probably should have managed today. I did an iron condor strategy, right, for Tesla. This was before they came out and said that, a bunch of things came out. But right now I need the stock to get to 330, right? So I did an iron condor. I've adjusted it a couple times on the call side. I collected premium. I sold a call spread, and I sold the put spread, right? So that's called an iron condor. You're collecting premium on both sides. You do that if you think the stock's going to trade in a range. So unfortunately, I think I did that when the stock was trading up here. So I sold an out of the money call spread. Fine. Collected money on that. Closed it. Stock went down. I sold another call spread. The value evaporated out of that, and I bought that back. But I still have this put spread that I sold probably for around 250, I think. And now it's marking, it's a $10 wide put spread. Right? So management is important with these. And I'm kind of pressing my luck. I'm not really doing a good job. And I haven't been overly concerned about it, because the last 2 days the market has done very well for me, and I've got a lot of other places where I've made money. However, there's no excuse for this. What I should be doing is I should probably take this trade off for a loss, because right now the price is below my upper strikes, right? So I sold the 320, 330, price is gone, dropped below. It's now marking at $6. The most I can lose is $10. And if I don't do anything, I've got pretty decent price risk going on here. So if this doesn't manage to rally tomorrow, I should probably roll this. Because a lot of times you think about rolling positions, and let's say if I waited till Thursday and the stock's still at 319, it's basically too late. That's not a roll. That's basically a new trade. Because what will happen is, let's say the stock goes down a little worse, goes down further out of my favor to, let's say, $315. And I sold, again, my strikes are the 320, 330. So I'm going to lose, I could lose $10. And let's say by Thursday, right now that spread that I'm short is marking at $6. Again, I want to collect premium. I don't want to see this go, to $10. So let's say by Thursday it's marking at $8.50 or $9. I could push the spread out, but now it's a whole new trade. Now it's still, I feel like I've waited a little bit too long because the move happened so quickly. I should really be moving that, rolling that spread out once it gets to around $5. So it's a little bit late. I'm a little bit late doing it. I should have done it today, but Tesla moves so much that I figure I just need one day of a rally. The problem is if it goes down, which you know how volatile this thing is, if it goes down $10 tomorrow, it'll be the value will be $7 or $8. So today would have been the correct day to do it. So you don't want to get to the point where the stock again is you're close to expiration, and the stock's marking at for a short $10 spread. If it's marking at $9, you've waited too long. It's a very important principle there because there's nothing, then the risk is not in your favor to take the trade off because you're gonna close it out realizing a $9 loss. You almost might as well wait until expiration and just say screw it. If it manages to rally back, now the risk is in your, if it manages to do something crazy on expiration and rally, you could get rewarded for that. But closing something out at $9 is not smart. When you could lose, the maximum you could lose is 10. Any questions? I think that's basically it. I kind of went through the credit stuff. I could answer more questions about the credit stuff, but I don't want to go too much past an hour, which we already are. But that's the advantage. I mean, hindsight being 2020, as the market is continuing to grind higher, it's a great strategy just to collect premium. You're basically, that's why I have the first bullet up there, can collect money for pass and go. Like as long as the market grinds higher, doesn't have a huge setback, you're going to continue to do well. There used to be, I forget the name of the trader, there used to be a trader that used to run a program all the time where, I forget, Webb knows who it is, but this used to be their trading platform or their trading program where they would just sell out of the money calls and out of the money puts, not spreads, just straight out of the money. And they had a couple moves, where I think the market sold off and it just continued to move down and they could not recover their, the value of their investment. A lot of times once people will do that who are very good at doing this philosophy, they'll continue just to roll further out. The problem is every time that you're losing money with that trade, in order to make that original trade profitable, like for Tesla, for my example for Tesla where it's $10 wide, if I want to make that original trade profitable, tomorrow I should close that and then I would have to take more risk. So instead of selling a $10 wide put spread, I would need to sell a $20 wide put spread to collect more premium to offset the loss of this trade, right? So that's the management that some people do with these spreads. The problem is, like if Tesla continues to go lower, now you have a bigger loss than you had. And so they kept on compounding it. They're like, okay, well, we'll sell a $30 wide put spread as the stock goes lower. That didn't work. Okay, now we'll sell a $50 wide put spread. So now instead of your original loss of being $500, you could have a $5,000 loss just per one contract. By doing that rolling concept. So you eventually need the stock or index, whatever, to come back and reverse the other way. If it keeps going down, you could have a major mess on your hands if you continue to roll out. Because again, you need to keep increasing the width of the spread in order for you to make that original trade profitable. So I know that's going over this concept quickly, but people have gotten, for the most part, if it reversion to the mean, you're fine. But if you don't get that reversion to the mean, you're in big trouble. All right, guys, any other questions? And what's nice about this, that you could also, which I didn't really talk about, and I haven't done this trade. I did this trade in 2017, and it kind of didn't work for me too well. But if you have a long if your positions are mostly long, if you're mostly bullish. So we can look at the S&P right now and think about this trade. I usually wait until we get a little bit more overbought, until the RSI gets over 70. Like here, the problem is we could stay overbought for a while. Like this is what happened. I tried to do this trade back in October and we stayed overbought for a long time. So back in October of last year, right? I had a long, I was mostly long all through this. And I said, I'm going to be cute and I'm going to protect the rest of my positions and I'm going to sell out of the money call spreads in the S&P. The problem is we just went vertical, right? So that trade really ate away at my risk. Everybody understand that concept? So you could do that on the index side. If you're long a lot of single stocks and you're worried about the market going up too far too fast, you could collect a little bit of premium by selling, either in SPX spreads, which is better because I think the tax treatment is better. But you could take advantage of this run up and you could sell out of the money calls. Maybe the 3,000 at this point, going out a week or two, and you could do the 3,000, maybe 3,010. So $10 wide, and you could collect a little bit of premium in case the market comes in a little bit. You have a little bit of insurance. So if the market does come in, you'll collect money by selling the call spreads on the S&P. However, if we do something like this, you're gonna eat away at your gains on your long portfolio because you just sold a $10 wide call spread. You collected maybe $2.50, $3, and the market gets stretched and you lose $10. You lose a net of $7. But it's something to think about. It depends on your view. Maybe going into September may not be a bad idea if you think that the market is going to be a little bit weak. But again, you could look at what happened last year. We dipped a little bit in August. Last September was a pretty good month for the market too. We didn't really have much of a pullback. So it's a dangerous game when we're rallying like this. So that's why you haven't seen me put that trade on. Because like I said, I did it last fall, and it did not work. I ended up losing. I ended up eating away at my returns on the long side. So I would personally wait until we get a little bit more overbought before I think about doing that trade. All right, guys. Any questions before we end the webinar? I hope this was useful for you guys to kind of sit down and go through something to think about. Calendar spreads are something else that we could cover on another webinar. But there's a whole bunch of different strategies that if there's no I know sometimes different trading rooms they give these webinars for different strategies. Just like we were talking about with MasterCard and with Amazon and so forth. There's no okay, you do this strategy and you're going to make money. There's different, like I said, the way to think about it is it's a different tool in your toolbox for doing certain things. If the trade, and I didn't really go over this concept, but if it's a very low volatile name, like Johnson & Johnson or XLV, right? This is the healthcare ETF. If we bring up the option trade, so this is the last thing I'll go over. But I think this is important too, because it's just another tool in your toolbox for different situations. There is no tomorrow I'm going to go out and put on a whole bunch of call spreads. No, think about it in each situation. What's better? Is it the calls or is it the spread? What are you expecting the stock to do? And then you could kind of put together the strategy of what. So for example, if you go out to October, right? Let's say you want to put on a trade for October, a swing trade for October for XLV, which has rallied very decently at this point. But let's just say, because this is a trade that I've done before, do you want to use calls or call spreads? Well, look at the value of look at the implied volatility. If you want to do the 92, let's say the 92 and a half calls, it's only going to cost you $1. It doesn't cost you anything for the calls. So for me, right, there's no point in doing a call spread because the value of the implied, the calls are pricing such a low implied volatility. They're cheap, right? Because XLV doesn't move that historically, normally doesn't move that much. Same thing with Johnson & Johnson. No point in doing a call spread, in my opinion, because the implied volatility is so low. You could buy the basically $1 and change for about 70 cents. That's it. That's all you're spending for the calls. So there's no reason to cap yourself, by selling 20 cents against that position. Not in your best interest to collect premium there. Same. So was that it? Was there any other questions? Yeah, I think we covered everything. So yeah, there is no one all and be all. It really is. It depends what you're comfortable with. Depends what you think is going to happen with the stock, and it depends on the stock itself and the price of if it's a super high price stock or if it's a super high volatility name, right? I'm looking at this chart. I forget who brought it to my attention. In here, no way I want to buy outright calls in this thing for a month out. It's just too expensive. That's not good risk to return. I would rather buy the stock, but it's got to hold the 50-day moving average. But it's the implied volatility when you're looking at an implied volatility of 100. Way too much, in my opinion. Well, we just went over that. We just went over that concept, Peter. I mean, what do you think? I mean, it depends what you think is going to happen. I mean, if you think we're going to sell off, then maybe that strategy is for you. I don't really have a reason why we're going to sell off. Could it happen? Sure. But why do you think the market is going to sell off? Just because we went up, so it's really depends. If you have a catalyst for why we're going to sell off, then maybe that's something for you to think about doing, a strategy for you to do. But I'll tell you from my personal experience, right? And again, because you go back to what we did last year. And again, I'm not saying that this is going to happen. This was very unusual last year, towards the end of the last year. But if you would have said, okay, we broke out a couple days, 1, 2, 3, 4, 5, and you said, okay, that's it. I'm selling call spreads. We look at the RSI. It's an 80 RSI. By the way, I'm going to stop the recording here.